RBI Governor Shaktikanta Das warned earlier this year that banks could not perennially rely on the central bank's money to support their loan growth. Instead, he called on lenders to mobilize their own funds and resources. The governor's concerns were backed up by a recent State Bank of India research report that said that credit or loan demand was at decadal highs and liquidity remained significantly downsized. The report highlighted that against this backdrop, banks were not adequately pricing in credit risk. Latest RBI data showed that as on the 21st of October, bank credit growth was almost at 18% year-on-year, while deposit growth lagged far behind at a shade below 10%. Deposits are not the only source from which banks can give loans. There are capital and reserves, along with borrowings from the market that can support loan growth. Still, banking expert Tamal Bandyopadhyay warns that banks will soon find maintaining the current credit growth challenging unless they are able to mobilize more deposits, which are the mainstay of banking in India. The pressure on banks to mobilize funds comes amid a significant change in the landscape of liquidity in the banking system. When the COVID crisis engulfed India in March 2020, the RBI accelerated the pace of its liquidity infusions in the banking system in order to foster confidence in the functioning of financial markets. The central bank pumped in huge amounts of liquidity through its program of government bond purchases as well as targeted long-term repo operations. However, with the RBI having firmly trained its sights on bringing down elevated inflation since April 2022, the liquidity surplus has shrunk significantly. From around 7 to 8 trillion rupees in April, the surplus, as measured by the RBI's liquidity absorptions, narrowed down to around 1.3 trillion rupees in October. The central bank's steps to prevent excessive volatility in the rupee's exchange rate have also contributed to liquidity being drained out of the banking system. The RBI has been shielding the rupee from too much turbulence through sales of US dollars from its reserves. Wednesday's meeting with bankers to discuss the situation on deposit growth comes after public exhortations by the RBI for banks to raise deposit rates and garner funds. Following the monetary policy statement in August, the RBI governor had called on banks to mobilize their own resources to fund credit growth. Das reiterated in September that banks must raise more capital in order to sustain the booming loan growth. Banks have been much slower in passing on the RBI's rate hikes to deposit rates than to the lending rates that they charge. While this has ensured stellar growth in profits in the first quarter, the pressure is building on banks to now increase deposit rates and attract funds in a highly competitive environment.
We're talking of the busy season beginning. And during the busy season, typically there is an increase in growth in credit. And if this happens, we need to have enough deposit growth to back it up. So the fact that the incremental deposits are lower than the incremental credit would be something which would be a concern for the Reserve Bank of India.
By mid-October, banks gradually began raising deposit rates after what one report described as months of reluctance. The lenders that did so included ICICI Bank, HDFC Bank, Yes Bank, and Canara Bank. However, rising deposit rates will affect the net interest margin of banks. This is the difference between what a bank pays to depositors and earns from borrowers.
There's been a migration of financial savings of households towards mutual funds, in a very small way towards small savings, and in a larger part to stock market directly. So there is a case of saying that the overall channeling of savings to the banking sector itself has slowed down, and there's no reason for us to think that this is going to change unless deposit rates are raised substantially, and therefore there will continue to be this gap between growth in deposits and lending. Lending, of course, may slow down because even the RBI's projections talk of GDP growth slowing down in the third and fourth quarters, which means we may not be seeing this kind of buoyant increase in credit, but credit will definitely continue to increase, in which case I think there's going to be a problem on the liquidity side, which has to be addressed by the RBI in case it exacerbates.
The challenge before the banking system is clear. It has to keep the net interest margin healthy in a rising interest rate cycle, while also raising deposit rates further if necessary to garner durable liquidity.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.